Welcome to the Millennial Investing Podcast. I'm your host, Clay Fink, and on today's episode, I'm joined by Wes Gray. Wes, welcome to the show.
Hey, Clay. Thanks for having me here.
In preparation for this interview, I was listening to one of your episodes with Preston and Stig on We Study Billionaires back in 2016, and Preston asked you if you're taking any money off the table in the equity markets due to how expensive it was. And it's pretty funny looking back in retrospect, considering how much farther the stock market has run since then. The S&P 500 is up over 2x since that time period. With that, I wanted to ask you if your strategy as a value investor has changed over the last 5 years since that interview with the market environment we've seen since then.
You know, I would love to go back and cheat to know what I said. Let's just see if I maintain consistency. So my guess is I probably said, I think the thing's totally overvalued, but I don't care what I think. I follow trends. And if the trend is strong, I own the market, regardless of valuation. If the trend is not strong, I start getting more skeptical and I'm willing to move out of the way. So hopefully I said something along those lines because my ideas have not changed on that subject. We'll have to fact check that. But my philosophy is still the same today. If the market is trending and it's strong, it doesn't care about valuations. We're in a sentiment world, and fundamentals are less important to trying to make money. Clearly, we're in one of those markets right now. Maybe in recent memory here, it's gotten a little bit more shaky, at least on the gross stock side of things. But I'm still of the same philosophy. If a market's trending, be willing to own it. If it's not trending, that's when you might want to think about, being more defensive and risk off. And in specific to value investing, like our process, our approach, honestly, the only thing we've changed there is made it simpler and easier to understand. But fundamentally, we haven't changed anything, right? It's same process. You could take the quantitative value book we wrote in 2012 with Toby, who you probably know, and it's 99% the same that we talked about back then. That's what we're still doing today, unfortunately, based on the past 10 years. But, we still fundamentally believe in buying cheap, high quality around the globe, and we'll continue to do that.
One thing that is very unique for you relative to many of the other people I've spoken with is your academic background. You got your PhD in finance and worked as a finance professor for a number of years. So I'm curious how you maybe see the world of investing differently than others through that lens that you have.
Yeah, I would say the key difference is I just had to eat way more humble pie. Because I started off as obviously a fundamental stock picker, totally obsessed with, discretionary, try to be Warren Buffett type deals. And I think what happens is once you go into the highest levels of academic research, the currency of that realm is not how much money did you make or how'd you beat the market. It's all about like intellectual heft. And so it's a great environment, to go peer to peer in a place where people just want to tell you you're an idiot and your ideas suck. And so I think through that experience, I've just gotten a lot more used to just recognizing that, I'm probably not as smart as I ever thought I was going to be. There's a lot of really smart folks out there. And for me, it's just all about keeping it simple and sticking to systems, not trying to outthink it. And so I think being an academic and being in that sphere where there's a culture of just, no, your idea sucks and you're an idiot and you're stupid and you're a loser. It kind of gives you it's great for protecting you on overconfidence, on believing your own BS, basically. So I'm happy I had the experience, even though it was painful.
One of the things that comes to mind related to that and related to the academic background you have is that investing, after a year, you might have the stock you buy might do really, really well, but it's difficult to know if it did well because for the reasons you originally thought it would do well, or if it was just purely based on luck. And I think just looking at the academic side of that is really interesting, I think.
Yeah, so that's another huge component besides humble pieing is one of the whole points of going to a PhD program is basically to learn how to do good research. And as a lot of people are aware, not just in the investing realm, but in every realm, like being good at research and understanding how data can be manipulated, studies can be manipulated, and you can basically make the data sing whatever song you want. I think that's important training to have. So you basically just don't believe anything anyone puts out there until you replicate it under your own conditions, kind of like doing the good old fashioned scientific method. And a lot of people just don't have that capability. Like it's just too much knowledge, too much data, too much programming requirements. And so we have that luxury where, yeah, great, that's an interesting idea. I don't believe it. I don't care how many Harvard PhDs you have, because guess what? We're going to go replicate it under our conditions. Maybe extend the sample, beat it up here or there, and convince ourselves it's a good idea. Where we just haven't have that unique skill set by being trained in the dark arts of doing academic research.
It's very interesting. You are a very data driven investor, and we're going to talk a little bit about momentum investing. But first, I wanted to ask you about finding value internationally. There's a lot of talk of investors looking internationally for value due to how expensive the US market has gotten on a relative basis. For investors that are broadly diversified in the US market and with how widespread companies are becoming as far as expanding internationally, is owning something like the S&P 500 getting an investor enough international exposure to hedge the risk of the US market specifically taking a beating?
There might be an element of that, but the better way to think about this is what you want to own and at what price, right? So, for example, let's take the most simple example. Acme company that trades in the U.S. but has 100% of its revenue in outside of the U.S. and it sells for a PE of 30. Then you got XYZ company that trades in Europe and has 100% of its business in the U.S. but it trades at 20. I would rather own the European one because it's fundamentally cheaper, even though it has 100% of its revenue in the States, right? So when people make that argument like, oh, well, why would I go international? Because I could just own US stocks. Well, yeah, but you're paying 30 times earnings versus 20. So, and international companies, it's not like they only do business in international. They do business in the States a lot of times at a higher frequency that we do business over there. So I would say from a perspective of just a value investor and some stats for you, like right now, we run like systematic value, US, systematic value, international. On the US side, like the operating income yield on our US funds, like probably around 14%, which is a lot. The US market is 4%, so it's triple. But in the international market, it's almost 17%. So, and the international market itself is probably, I don't know, 5 to 6% yield. So, I mean, you can just on an absolute basis find way better deals internationally. And, so I think you probably want to invest everywhere, be globally diversified. And it makes sense to just go to where the cheapness is and not rely on the old, Warren Buffett quote, which a lot of times he simplifies a lot of things that people get lost in the weeds, that he probably wouldn't tell you that all the time. Like a lot of people are like, well, Warren Buffett said just 90% US stocks, 10% cash. Well, yeah, maybe, but that's just because some reporter asked him for a simple answer to a simple question. But I don't, does he do that? No, he makes a ton of acquisitions outside the States, so watch what people do, not what they say.
That makes sense to me. Now, let's dive into a topic that is very unique and something that you know a lot about, and that's momentum investing. Could you talk to our audience about what momentum investing is?
Sure. So the first thing I would like to highlight is this audience is probably more value minded. And just so you know, I'm on the same team, right? Like I'm genetically programmed to be a value investor, totally get it. It makes way more sense to me. But unfortunately, after enough beatdown, I've came around to evidence-based investing as well, and just believing in humans, and they love fear and greed, right? And I always tell people the easiest way to think about it is value is kind of the fair trade, right? Buy stuff everyone hates, hold your nose, wait for a long time, take the pain, and then eventually it works, right? But there's another thing in humans called greed, right? And why are we exploiting that, right? Or the beauty contest, right? The world is not about fundamentals all the time. It's about selling something for more than you bought it for in the end, right? And so that's just high level background. So you don't think I'm some wacko, technical momentum trader. I'm part of the religion here, people. But momentum is also interesting. And essentially what it is it's just buying winners. So stocks that are doing really well relative to all the other ones, in general, we want to own those securities because they tend to keep on winning. And they're very different than the exposures you're going to get from buying value portfolios, essentially.
Is momentum investing essentially taking advantage of the psychological side of investing, where a lot of people want to buy assets that are going up, and a momentum strategy essentially rides the wave of new buyers coming in, continually pushing up the prices?
Yeah, I think that's definitely an element of it. Like it's the greed component and the FOMO component. And it's just like all assets, once they get the ball rolling on FOMO, it just attracts more money because people love shiny rocks. So I would say that's certainly one aspect of the psychology that contributes to momentum. The other one is ironically underreaction to the positive news that price momentum brings to security. And I always give the examples of like, it's called reflexivity. But the concept is, if you're trying to attract talent, attract buzz, trying to acquire companies, I always say like Amazon has a way cheaper cost of capital because they can go make, they could go make a purchase of Whole Foods with their stock and it costs them nothing. Whereas a value player that has bad price action, they have to pay cash. And so there's a lot of benefits to having fundamentally really strong price action. You think about, not Cathie Wood anymore, but before Cathie Wood blew up, like Cathie Wood, Elon Musk, Amazon, these people have this special trump card where they're against their comrades they compete against. Their cost of capital and ability to get stuff done is just way cheaper when you have great price action, because you can essentially use your stock to like improve your fundamentals, but in like a reflexive way. You could track better talent. There's a lot of things I think are second level thinking that are actually tied to price momentum that retroactively contribute to fundamentals in a way that value investors never appreciate, because they're so focused on like what's going on here and now that they're now, I'm not going to say they're not second level thinkers, but it's just the nature of humans. Most people are first level thinkers. And I think momentum has some interesting second level effects on fundamentals. And so in many respects, they're kind of a value trade in that way, because people underreact to, potentially better news than they were expecting.
You mentioned that companies that have a strong price action can have a lower cost of capital. Could you dive a little bit deeper into that and what the cost of capital is and how that works?
Yeah. So let's just take an example of Amazon versus Walmart, right? So like Amazon is a great example when they bought Whole Foods, right? When Amazon bought Whole Foods in a stock purchase, their stock went up more than the acquisition cost. So it was basically free, right? Whereas Walmart has to go out and pay billions of dollars to buy jet.com with cold hard cash, right? And maybe there's some stock involved in that deal. And I don't know all the intricate details. This is just a quick example. But the concept is or another example might be like Elon Musk and Tesla versus GM or Ford, right? Let's say they're equally going to go out there and try to raise money for EV, electric vehicles. I guarantee that Elon Musk could go raise that capital for basically free because people love everything about it. The price is there. He's made so many people rich. They'll throw money at that problem like no other. Whereas GM, if they have to go to the market to raise capital, they're going to have to throw hard money at the problem. And when I say by cost of capital, that's just what is the charge that the market kind of imposes on you and the return that they expect for you to use their money, right? Whereas Elon can go raise capital at valuations and, at nosebleed levels, they're probably expect a return, even though they don't think it is probably zero, right? Whereas if GM goes to the marketplace and tries to get money to fund EV, they're going to have to pay people a return because they're going to be like, man, I don't trust you enough. Like, you're ugly. Elon's way cooler, which I actually agree with. He is really cool. But, I wouldn't necessarily want to be an investor in his offering versus like GM, because I'm sure the GM offering, I can extract like, well, I need to get at least 10, 15, 20% returns on this investment. Whereas if I were to impose that on Elon, he'd be like, well, I'm not talking to you. I'm gonna go talk to all these other people I could raise equity at like 1,000 times PE ratio, right? So that's what I mean by cost of capital. It's basically what do you have to like put out there as fish bait to get the fish to bite so you can like catch them. And a lot of times firms or institutions that have really good price action, because it kind of self-reinforces how awesome they are, at least in a short-term memory sense, their capability to raise capital and get things done is just a lot less than people that, their stock's in the shitter and, no one likes them. They're, whatever. And again, that's just more of like a human psychology thing. The other thing you could think about, another just kind of simplifying example is let's say you're an engineer and, you may not know a lot about finance and like valuation or fundamentals, but you know that when you're an engineer and you go work for a tech company, you get paid in stock. And you go, you're not a finance person, so you probably use past performance as an indication of how great your option value is going to be. Are you going to want to work for the firm that's, had amazing 10x price action and all your friends are getting rich? You're going to go work for like a firm that, had an 80% drawdown and they're like, oh God, like who would want to own those options? So even though fundamentally, like they might want to actually look at the actual valuations on the companies they're about to work for when they get those options issued to them, most humans don't think like that. They're going to be attracted to the shiny rock of I'm going to go work for whatever, Google or Microsoft right now. And then I don't know what tech firms have crappy price action, but like, let's say there's some crappy price action tech firm there, let's say Intel. That's probably not the case because they're a value stock right now, but pretend Intel had bad price performance and they're competing against like Microsoft right now for talent and the stock prices are diverging. Those engineers are going to want to, at the margin, be willing to work less and harder for an opportunity to be at Microsoft versus like Intel, because it's just lame, right? So it's just price action creates weird incentives because there's a lot of people that are not just investors, but constituents that are just, performance chasers, basically. That's kind of a fundamental, humans are like, what is it? Like flies, they see light, they just run to it and die. The same thing like people, like they see big performance. Even though we know what happens, you're going to die if you chase performance. They just go to that light and kill themselves. And it happens every single time. It's just, I don't know. It just is what it is, I would say. But momentum is a way to try to, basically take advantage of that. Like essentially you're selling the light. Great. Come on over to my light. We'll try to catch a little spread along the way.
So is the process of figuring out when to buy and sell these momentum picks totally automated by computers on your end that are running these calculations based on the movement?
Yeah, you don't have to do that. But the problem with momentum, especially for someone like me who's so wired to be a value investor, if you see what the computer tells you to do, you're just not going to want to do it, right? And so there may be other people that are not wired like that, and maybe it's easier. So for example, me, like when I look at the value names, I understand most of the marketplaces be like, God, why would you want to own that turd? But to me, that just smells like money fundamentally, right? I get excited because I'm wired for being a value person. Whereas on those momentum names, like, again, I could see someone out there that could probably do this in a discretionary way, but I need the automation of the computer to force me to do it. Because if I start getting in the weeds, I just know my own biases will prevent me from doing the actual momentum strategy that actually, has the data and the evidence and the psychology behind it. So we're just fully automated. Not saying that's for everybody, but definitely for me.
It's really hard to ignore this idea of momentum because Preston actually ended up putting together a momentum tool on our TIP finance tool on our website. So I find this just really, really interesting. Do you think that
Sure.
do you think that momentum investing debunks the idea that you can't time the market?
Mm, I mean, there's so many things that debunk that theory. It's just the problem with like the can't time the market is that's through the lens of U.S. investor psychology, who it's always paid to be a buy and hold. But just think about it intuitively. Like, if I'm a holder in like Zimbabwe equity, are you going to be wired to, like, I guarantee you ask any like Rhodesian who's now a Zimbabwean, hey, you think you should just buy and hold equity through thick and thin, no matter what, till it goes to zero? They're going to be like, yeah, right. That's stupid. You should have risk management. So I would say the same thing applies in all markets. Like you should probably trend follow or like, maybe, or use momentum or momentum signals, because in the end, like you don't want to ride a train to zero. And it just happens to be the case, and God bless America, but like the US is like the greatest survivor bias experiment of all time, where every single time we've been on the precipice of like potentially dying, we've came back even stronger. And I believe in freedom and like our systems and everything. I think they make robustness to allow that to happen, but I don't really know. Like maybe it was a lucky run. So I would say in general, using momentum, using trend, and this idea that you should risk manage and think about your exposures, i.e., you should market time, is just common sense. I think people that don't incorporate some element or ability to market time are just crazy. Like I think Meb Faber has a great poll he always does. Would you own the S&P at 50 times? Great. A lot of people say, yeah, buy and hold, baby. Vanguard. Then he says, what about 500 times? And they're like, yeah, buy and hold. Go. And he's like, okay, what about 1,000,000,000,000 times earnings? You're still going to own it? Like at some point, you just can't be religious or dogmatic about anything in the marketplace. And so anytime you hear people make the claim that, oh, market timing is a bunch of bunk, you can't be done, they're just not thinking straight about it. Now, should you be engaged in trading? Should you like day trade and not consider frictional cost, taxes, and like your behavioral biases to like want to do something all the time? Well, of course, but you shouldn't also at the same time write off, being tactical and being savvy about, hey, we might want to avoid the S&P 500 if it's at 1,000,000,000,000 times earnings. Just saying. And is that market timing? Yeah, but that's also common sense at some level.
So is it fair to say that some portion of your portfolio is these value picks that in general you're just holding, buy and hold for the long term, and these momentum picks are another portion of your portfolio that you are incorporating some sort of market timing and figuring out when to get in and get out?
Yeah, so even on value, we incorporate elements of risk management, even in like a deep value strategy. So for example, like in quant value, the fundamentals of that process is up front, we're going to boot anything out that has like horrific momentum or horrific fundamentals, what have you. So already, like, let's say you own some stock that, is really cheap, but all of a sudden it's got like horrific momentum and horrific accounting problems. Well, we're getting rid of that, right? We also have like large elements of quality in there. And so same thing, you can be like the energy patch was like this probably like 5 or 6 years ago, where it's like, oh my God, this is really cheap. Oh my God, it's also like total junk. And like, why would you ever invest in this? So we would get rid of that fundamentally, right? So even in our value system, there's a lot of like, fire alarms on there where we'll be willing, either on quality, degrading quality, really crappy momentum. just be like, you know what, that's really cheap, but why would I want to mess with that? Because it's like playing with fire. So it's built in there. And then obviously on the momentum strategy, I mean, that one's obvious. Like if it has momentum, we own it. If it doesn't, we get rid of it. And unlike value, where you can kind of like take your lumps and you don't need to trade it a lot to get it to work, like in momentum, which is very opposite because it's much more psychology based strategy. If you can't like rebalance a momentum fund once a year because you'll die, right? You need to be able to get out of things that are blowing up because that's momentum, right? And then when things change, it changes quick. So it's just a different strategy. It has a lot more or a lot less leniency with respect to turnover and trading and needing to move. We're value investing kind of, you can sandbag it, go slow, take your time, and you're not going to get hurt too bad generally.
I'm curious, what did your momentum picks look like in March 2020 once things started to turn? Did your tool figure out, yeah, something's going on with these momentum plays? They're starting to turn over. So were you able to get out prior to most of the damage was done? And then to follow up on that, were you getting back in? Tell me a little bit about that.
Yeah. So in general, in March 2020, if we got lucky in momentum, like value got absolutely destroyed, as you can imagine. It just didn't matter. There was no bids. I think QVal was down like 50%. And then if you were in smaller names, I know people that run funds like intra-month, they had like 75, 80% drawdowns, which is crazy, right? Momentum also obviously had a big drawdown, but because by nature it was owning high momentum names going into that, and a lot of the high momentum names were like tech, the things that just, for whatever reason got relatively lucky, they didn't get beat down as hard. And then also just by dumb luck, like coming out of that March 2020, we have this fund, it's called QMOM. The thing went on like the biggest bender of all time. I didn't even know about it because I was an idiot in March. I was like, hey, I'm doubling down on QVal and IVal. This is too crazy. And I was all proud of myself because, like a year later, they're up a lot. But then but actually I was an idiot because if I had bought like the momentum stuff, it would have been 2x that, right? So momentum on a relative basis, did well in March 2020. But that's just is what it is, right? Like, it's all about the luck and what the market gods bring you. Like momentum in the last year has, gotten annihilated, whereas like value's gone the exact opposite. So it's one of those things where, who knows? That's why I like to own them both. But, sometimes they work, sometimes they don't.
Hey everyone, Clay Fink here, host of the Millennial Investing Podcast. Today, I wanted to tell you guys about this exciting new investment tool called Titan. Titan is an investment platform that was made for everyday investors that want their money actively managed by a team of experienced analysts. With how hectic life can get at times, why not outsource your investments to the experts? They offer 3 equity portfolios and America's very first actively managed crypto portfolio. Since launching each portfolio, Titan has outperformed the benchmark in 3 of their 4 portfolios on an after-fee basis. They aim to grow your investments by 15% annually. And at this rate of growth, this implies your money doubling every 5 years. My favorite fund is their flagship fund, which invests in the highest quality large cap growth stocks in the US. Join the smarter way to invest with Titan. All it takes is $100 to get started. Right now, if you sign up through our link, titan.com/TIP, you'll get your first 3 months of investment management for 0 fees. That's titan.com/TIP for 0 fees. How do you determine which companies to utilize in a momentum strategy?
So we, again, having my own bias, and this is not just me, but Jack, who's my partner in crime, I'm doing all this research. We're value guys, so we always think God, when we do momentum, we could probably improve that by doing some quality checks or avoiding these obviously total horrific companies from a value perspective. And every time we've tried to impose our thoughts, which we never just do thoughts, we always go test them. They just don't work, man. With momentum, if you want to capture the momentum effect and you want to try to exploit greed and exploit like this, reflexivity and market price action, you have to focus straight up on either price action, or you could look at fundamental momentum too. Like if you look at earnings keep beating the earning expectation, it's the same idea because they're basically one and the same effectively. But the minute you try to impose like quality or valuation, anything that smells like a value investor was involved, you're just going to ruin the momentum strategy, period. Trust me, I've tried to make momentum feel like value. It just doesn't help the situation. I wish it did, but it just doesn't.
It reminds me of something like Rivian, it's a company that went public with,
sure,
I believe, 0 cars sold, and it ran up to $100 million market cap. I have no idea what the stock's at now, but for a period of time, it's doing very, very well.
Yep. No, exactly. It's just, it's like a lot of things. That's why it's important to be able to do research and like test ideas you have. And you don't want to go back testing run amok. But if you have ideas and you think there's like first principles behind them, it's always good to just test them a variety of ways. But and we've done that. But the issue with momentum is, I think the first principle, now that we have a much clearer understanding of how and why it works, it's the same thing with like, if I'm a value guy, why does that work? Well, it's probably because you're buying things that are, let's be honest, probably a little bit riskier. But then also we're just buying things that no one else wants to own. And the expectations are so horrific and so bloody and nasty that you just have that opportunity. But the trade-off is you got to deal with the pain and anguish of it, right? And you're just trying to take advantage of fear in the marketplace. Where momentum, like the first principles on that is it is a shiny rock greed trade. And to the extent you believe humans like shiny rocks and like greed, and like they're, the flies fly into the light and they always die, as long as you believe in that as a first principle, why would you do stuff that takes away from that first principle? And in momentum, if I'm putting quality or valuation bound, like all I'm doing is I'm no longer in the greed trade. Now I'm back in the value trade. But the whole point of doing momentum was to do something different. Because I already do value investing, right? So it's a tough, investing's tough. It's the bottom line. And being lucky is great. It'd be a lot better to just be lucky than overthink this stuff. I like Preston's Bitcoin move. Not saying I was lucky, Preston's listening, but hey, there's probably a lot of luck involved in a lot of things in life.
One thing you mentioned there is that value investing a lot of times consists of buying companies that are a little bit riskier. Could you expand on why you believe that to be the case?
Yeah, so this is something that like value investors don't like to admit, because they're like, I know how the religion works. Like, well, buy a margin of safety or whatever. And they got a lot of cash in the till, blah, 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 right? But let's be honest, like let's go look at like Kohl's, right, versus Amazon. Like, okay, Kohl's, I'm just making this stuff. I don't know what Kohl's sells for right now, but it used to sell for like 8 times PE. And it's got high quality, they make money, blah, blah, blah. Amazon obviously sells for like 50 times that, and what have you. And so the minute you take that bet on the valuation spread between Amazon and Kohl's, well, what is Amazon has a low cost of capital, i.e. a high valuation, because fundamentally to execute on their business plan, it's less risky, right? Whereas Kohl's, to be able to transition to this new world, they got to do a lot of things right? They got to figure out their online presence. They got to figure out how to protect their turf with their stores. So it's fundamentally riskier, because also they have assets in place in the ground. They got a lot more operating leverage there, where Amazon doesn't even have stores, right? So a lot of times just the business models tied to value, quote unquote, value stocks, i.e. cheap, high quality things that sell for less than 10 PE versus other securities that sell for, 50. And I'm not saying that risk explains all that spread, but it would be kind of foolish, and the evidence would suggest that you're a fool that the differential in the valuation between classic value stocks and growth stocks, it's not just 100% mispricing and the market's stupid because they don't know that your shiny rocks or your shiny turd is actually a shiny diamond. It's you're just buying more risk. And so you should get paid if you're going to buy companies that are fundamentally riskier, their business model is more at risk or whatever. Yeah, you should earn extra money because you're doing something that other people don't want to do. And now that said, I also agree that people throw the baby out with the bathwater a lot in these value stocks. And so, that the difference between like the 10 PE and the 30 PE, yeah, part of that is probably for risk, but there also is a part that people are just crazy and they just don't want to, they would rather own Tesla than GM or whatever. Who knows how to quantify like the mix between the risk and mispricing, but I think it'd be foolish to not suggest that there's probably elements of both involved.
Yeah, that makes sense to me. Your Kohl's and Amazon example, because obviously Kohl's is completely being disrupted and displaced by Amazon. I think someone could argue, say, something like Berkshire Hathaway. I think somebody could argue that it's a great business at a reasonable price. So how do you see that as something that's riskier than, say, like a tech company or owning like the S&P 500, or how do you look at that?
It would depend. So I don't know the exact valuation discount on, Berkshire's whole portfolio versus S&P right now. But regardless, the way I would analyze any situation is on the first principles of, okay, there's a valuation discount. What I don't know what it is. Like, it's 10%. Well, does 10% justify, like, maybe there is an additional risk, right? And maybe there isn't any mispricing. That'd just be something you have to analyze on a case-by-case basis. And this is what fundamental, discretionary value investors rack their brains on all day. I do all this quantitatively and in the tails, right? Like, I immediately am only going to buy stuff that's in the 10% cheapest of the entire market. So I'm never going to get into these pissing battles between, Berkshire and XYZ, because Berkshire is not the 10% cheapest stock, right? Like, clearly it's probably more market efficiency price than in the tails, right? So I just focus in the tails, and then like fundamental discretionary managers, they can go quibble and quabble over, the differences in the valuations on things like that. But the principles would still apply. And I would say just, without having a forensic deep dive or being up to speed on Buffett at the current time, just knowing how he invests, like, fundamentally, whatever the heck he's investing in almost certainly has more risk fundamentally tied to the economy, valuations aside, because he's going to be buying hard assets, things that free cash flow, energy, stack, like all that kind of stuff. Whereas obviously the S&P is 25% in like tech, right? Which just, putting valuations aside, just on a fundamental first principles of business risk, I see less risk in Apple than it will. Actually, Berkshire owns Apple, but that's not a great example. But whatever, Google, than I do in like, the railroad station. I don't know if Buffett still owns that, but like, they're just different businesses. Now, risk also is tied to the price you pay, right? Because, a railroad at 5 times earnings might be way less risky than buying Google at 5,000 times earnings. And so, but that's something that people have to figure out, right? Like, if there is additional risk, is it compensated, or are you getting a good deal, right? And so that'd be something a fundamental investor would have to determine.
Have you seen momentum investing to be a really successful strategy over the past decade, with us being in this really long bull market?
Not really, actually. The only, I was just actually looking up all the factors over the past 10 years for the U.S. and international. Actually got them here on our little tool. So if you just look like basically, if you're not familiar with factors, all that's trying to do is say like, hey, if I were to try to synthesize different characteristics of stocks, and we usually look at like value, the momentum, the quality, and the size. And I said, hey, like, how have those factors done? Like, if I tried to best I could isolate just how are those components returned. The interesting thing about the market over the past 10 years is, in the US especially, is the only thing that's made money is lowish quality, super big beta stocks, right? Values or last 10 years been a dog. Momentum's kind of like blah. Quality's kind of like blah. Like I said, like mega cap, like the size factor is kind of blah. It's really all about just been owning the S&P 500, honestly. And all factors across the board haven't been great, right? And so to the extent, like if you ran momentum and it was mega caps, you probably did okay, right? But if you did momentum and you had elements of like small or mid caps in there, because we know small as a strategy up until very recently has been a total dog, you know, maybe the extra momentum juice you got was overcome by like the size, anti-juice you got. So in general, all factors outside of just owning mega cap US stocks in the S&P at the highest mega cap levels, it hasn't done that well, right? In the international markets, it's a little bit different. You know, like you've had a little bit more mojo from, momentum, but in general, it's the same problem. Like value sucks, size sucks, qualities was okay in international markets. But if you just want to keep quality out of it because it can confound things, but if you just look at like size, momentum, and value over the last 10 years globally, I would say none of them have been great, and size has been terrible. It's kind of all about buying really big stocks that don't really have great momentum, aren't really especially, cheap. It just kind of own passive markets basically. And there's a lot of theories on why that might be. I'm getting more and more open to the idea. Well, I've always been open to the idea that fund or flows matter, right? There's a thing called supply and demand in the market. And initially I was a skeptic on the idea, like, well, everyone just goes passive and they own S&P 500 stocks, like no big deal. But at this point, it's such like an escalating pace, and Vanguard every day is buying billions of dollars a day, where they're literally their clients or someone is liquidating value, whatever, and they're turning around and going saying buy S&P 500 stocks. So if you start doing that at scale and everyone's doing the same thing, of course you're going to have influence on asset prices. And I think we have a realization event of the past 10 years, and I don't know when this will end, but stocks that are in the S&P 500 that get the most capital contributions have obviously kicked butt. And if you did anything that's not that, you underperformed, basically, no matter what it was. Like pretty much everything that wasn't that underperformed the S&P, because S&P is up like, I don't even know, it's like 18%, annual returns for like the past 10 years. It's crazy. So I don't know, but so honestly, nothing's worked that well. I should have just owned the S&P 500 the past 10 years. I've been a lot better off. So
making a pretty good case for passive investing.
Well, no, I think that's a case for if I knew what I knew now 10 years ago, and I knew the moths would all go to the flame at the same time at scale, and just assume that, you never have impact on prices and passive's a free lunch. Yeah. But we invest ex ante on a go forward basis. And to me, anytime you have a situation where people perceive something is free, has infinite supply, and always works better than something else, that never leads to outcomes that are favorable, because those equilibriums are unstable. It's impossible to have a good that is free, unlimited, and always works, right? Eventually, markets are good about mean reversion. And I think the whole passive craze is about to, like, I don't know when, because it'd be foolhardy to try to predict human psychology. But fundamentally, it's not in 50 years from now. It'll look like the Nifty 50. It'll look like many other episodes in the marketplace. It's just crazy.
So how can the typical retail investor use momentum investing in their own strategy?
Probably the best thing I would say is most people, frankly, are never going to wrap their head around momentum investing, especially value investors. Like I got a whole book dedicated to value investors trying to convince themselves to do momentum. But, it's like the old saying, you bring a horse to water, they're not going to drink it. And that's fine. That's cool. Like I always tell people, like, hey, only do things that you're convinced of. And things that Wes does, they could be the worst idea you ever had for you to do it, right? Like, and same thing for you may have like great ideas and they work amazing for you, but they would be the worst idea ever for me. So in general, I would say most value investors should probably not end up doing momentum unless they truly believe in the thing in their bones, but they could still use it as a tool. So for example, let's say you're kind of anchored value as a philosophy. Well, then let's say you're going to go sell some securities. Let's say you have a stock, you own your portfolio, and you're like, man, it's getting a little pricey. It's like, it's right at my target, but the momentum is like epic. Well, maybe you don't sell that, right? Maybe you hold on to it. And then if it hits a point where momentum flatlines or breaks down, okay, now I'll blow out of it. So maybe you use it as kind of like a tactical trading tool, or on the opposite thing is let's say you're going to, you're questionable on selling something. You're like, well, God, it's like pretty cheap, but but I got this other name I kind of like. It's maybe it's a little bit more expensive, but like the name that's marginally cheaper has like horrific momentum, and the other one that's marginally more expensive has like decent momentum, and they're both candidates for a sell. Hey, maybe you blow out the one that's got horrific momentum, because we know on average owning baskets of low momentum securities, especially in the extreme 10%, is like the worst strategy on the planet Earth, right? So if anything, you could, even as a value investor, you could probably use, these momentum things for like technical like indicators when to buy and sell at the margin. But you don't have to go full sell into the religion if you don't want to, which, that might be a way for people in the audience to use momentum as a tool if you're not, going to go all in or go buy ETFs that do these sort of things.
It reminds me of what value investors call a value trap. Sometimes value investors buy a company that has fallen in price because it's a company that's very underappreciated by the market and it looks very cheap. And if the price of the stock continues to fall, this is why it's a value trap, because you might get in and it might fall another, say, 25%. It reminds me a lot of Preston and Stig have done a lot of intrinsic value assessments over the years. And one of them was GameStop. It was a stock that just got crushed and crushed and crushed because everyone knew like retail is getting, completely disrupted. And then next thing you know, it's just funny how that's kind of those value traps.
Well, and that's actually a great example of price action affecting fundamentals, right? I'm a big GameStop fan as a user of the product. I got 3 kids now, so I don't get to use it as much as I used to. But I used to be a big gamer and still am. And so I liked it. But back in the day, I used to own it. It's a total value dog because it's just so cheap on cash flow basis and expectations were so terrible. But those guys couldn't get out of their own way trying to raise capital to help them out. All of a sudden, they go on the short squeeze. Price action goes bonkers. And now, because they can raise capital for like negative cost of capital, it seems, I don't know if that's a concept, now they're like fundamentally in a better position as a business than they've ever been in the history of their lives, just because of price action. Obviously, the fundamentals of GameStop have not changed basically one iota, on their core business. But now that their price action was so crazy, it did fundamentally change because they raised capital at nothing, and now they can go do experiments on the cheap with other people's money. And who knows, they may break out and become like a SaaS. God only knows what they could do now.
Yes. They'll probably start getting into the NFT space or something.
Because now they got free money to go burn on experiments, right? Because their cost of capital is zero. So price action matters a lot. And if value investors don't incorporate how price action affects their businesses fundamentally, then they're missing out on like a key component of value investing, which is cost of capital. It's like a big variable in your DCF, as you know.
So a momentum strategy, as you mentioned, requires frequent rebalancing and trading in and out of positions, which may lead to capital gains taxes, because assuming you are up on your position. And I'm curious, historically, how much of an effect does this have on the returns on a momentum fund?
So yeah, trying to do momentum as a retail investor, unless you got your act squared away on like your execution frictional costs and or you got like a tax dodge, or not dodge, we'll call it avoidance. It's silly to do it, right? We never did momentum until we got the ETF wrapper, right? Because at least the ETF wrapper, I can get rid of the problem. You know, I live in Puerto Rico now, so I can make a case to just do it organically because I don't pay taxes and cap gains. But outside of living in Puerto Rico or investing in it through an ETF, you know, unless you're going to use your qualified account, it makes no sense to do a momentum strategy on taxable money because, you know, you got to pay 50% back to Uncle Sam, and it's not that good, right? And that's just the tax, not to mention the frictional costs, right? Like momentum strategies, if you're going to do them right, you know, on average, you're going to be looking at 200% turnover. And so if you're not really good at execution, you don't spend a lot of time thinking about impact costs, like how to execute the trades, and you're just like winging it, doing market orders at Schwab, getting raped and pillaged with payment for order flow, God knows what else. You're going to get destroyed in frictional costs. So unfortunately, and I hate to say this because I'm a big DIY fan, but momentum is just not for retail investors, period. It is a system. Like, unfortunately, you should probably go, if you like it, go buy a product, go invest in someone else who's kind of doing this professionally, because they're just in a better advantage position than you are.
So do you think of your momentum strategy to try and enhance returns or diversify your equity exposure?
I think it's highly contingent on the circumstance of the investor, right? So, for example, if I go to Kathy Wood and I say, "Hey, Kathy, do you want a momentum strategy?" She might say, "Well, I don't know if that's a diversifier or a return enhancer, right?" She's already got like banked up risk as far as the eye can see, so it's not going to do anything. Whereas let's say you're a value investor that's hardcore, I'd say, okay, you probably got higher expected returns in the market. And, momentum is probably also an expectation, got higher expected returns in the market. But from a diversification standpoint, it's a slam dunk, right? Because when your stuff's yinning, this thing's yanging. And if you have two positive expected bets, but they're uncorrelated, there's going to be a benefit from a portfolio standpoint. So in that case, diversification would be great. And then a third example might be like, okay, let's say you've got, you just hate stocks. They're too risky. You're like 20% stocks, 80% bonds, or you put your money under your mattress. You're basically under invested in equities, but you need kind of like high octane. I might say, well, instead of, sandbagging it on like S&P for 20%, because you already got 80% of your money under your pillow, something like that, like a momentum strategy is going to be able to kind of amp your exposure with the same dollars. So there it might be an expected return booster and probably maybe a little bit of a diversifier. So again, it can go either way. It just really depends on the situation and how you use it as a tool.
Now, you've mentioned trend following a few times during this episode, which sounds a lot like momentum, and I'm not really familiar with trend following. So how does a trend following strategy differ from a momentum strategy?
Great question. And I wish you flagged me down earlier. So basically, because it's all about semantics, unfortunately. So when I talk about momentum, I am speaking specifically to relative strength momentum in the context of stock selection, i.e., the best example is I see two stocks, stock A and B. Stock A is up, stock A is down 10%. Stock B is down 20%. When I say momentum, it would suggest that I would prefer A to B, right? Because on a relative basis, A is doing better than B, right? That's what they call momentum, as it's used for stock selection. Trend following is not about comparing things at the same point in time across each other. It's about comparing the same thing over time. So for example, we had those same two stocks, A and B. A was down 10%, B was down 20%. With momentum, I would say, great, A is awesome, B sucks. I'm going to buy A and not buy B. With trend following, I would say, I'm not buying any of these things because A's trend sucks and B's trend sucks. So trend following is in reference to basically the absolute momentum on an individual security relative to itself, whereas momentum, at least how I use it, is in reference to a stock picking strategy that's all about picking the relative best, but it still could have terrible trend. And so when I talk about trend following, it's usually in reference to like broad asset classes, right? So if the S&P is, over its 12-month moving average, own it. Otherwise, consider risk managing it, right? But it doesn't have anything to do about what stocks to own in the S&P. Do I own GameStop or do I own GM? That'd be more like in the realm of what I call momentum. So it's a great question. And the problem is you need people to define it because some people call momentum, it's really just dependent on the definition and making sure you get down to brass tacks of what people are referring to. So sorry about that confusion. Should have mentioned that up front.
No worries. Wes, thank you so much for coming on to the Millennial Investing Podcast. You have your own momentum funds that if the listeners are interested in learning more about momentum, I highly recommend you check out his website, maybe look into his funds, his momentum funds, and I believe he has value funds as well. Before we close out the episode, Wes, tell us a little bit about your company, Alpha Architect, and where the audience can go to connect with you.
Sure. So we kind of have two companies now. So Alpha Architect has a firm mission, empower investors through education. It's alphaarchitect.com. And that's where you can learn about all the strategies and like all kinds of things related to factors. And then we have another business called etfarchitect.com, where the mission there is to help ETF sponsors win. And that business is focused on bringing other people to market who want to participate in the ETF game. So, if any of your listeners, want to convert into an ETF, launch an ETF, that's where they go. And then you can always follow me on Twitter, just at Alpha Architect. And those are kind of three good places to find us, depending on what you're looking for.
Awesome. Thanks again for coming on, Wes. I really appreciate it.
Yeah, appreciate it, Clay. Good chatting.
Thanks for watching. Make sure to subscribe and hit that notification bell so you don't miss out on our next podcast episode and new investing resources. What are your takeaways and thoughts about this discussion? Let us know in the comments section below.